Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two big retail stocks ahead of their upcoming earnings releases next week, which is part of a big week for retailers across the board. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new Zacks.com/promo for a look into some of our services, portfolios, and more. All right, so before we jump into the two big retail giants, I want to quickly take a look at the broader market as we've reached sort of the halfway point next week of November, and that's almost the halfway point then of the fourth quarter in the heart of the holiday shopping season. So give us a sense of everything that's going on. So the early November market momentum continued last week after the Federal Reserve provided clarity on its tapering plans. Stocks then climbed to close the week, with the Nasdaq and the S&P 500 both setting new records once again last week. And then we saw all three indexes hit new highs on Monday. And the S&P 500, in fact, hit its eighth consecutive trading session with a closing record, which was something it hadn't done since 1997. Both the Dow and the Nasdaq also climbed new records to start the week. That said, as of this recording in late afternoon on Tuesday, all three indexes were down, so we're not going to break any of these records for all-time highs at the close, because if we saw the S&P 500 hit its ninth day in a row of closing highs, it would have been the longest streak since 1955. But it's nice to have a bit of a pullback, as it seems like that's due considering that the S&P 500 has now jumped about 9% in the last month, with the Nasdaq up about 12% since it began to bounce out of some oversold technical levels in early October, with the Dow also up about 6% during that stretch. So as we mentioned, the positivity recently came after the Fed approved plans to begin scaling back its bond buying, in fact, starting this month, with the central bank hoping to end its run of stimulus-focused bond purchases by early June, while leaving its interest rates unchanged during this stretch. So the market seems pleased enough with that, and it's really continued to show its love for the stronger than projected third quarter earnings season. Wall Street's also pushed markets up to these new highs despite rising prices and supply chain bottlenecks, because we have not seen these headwinds materialize within the broader S&P 500 margins picture for both this year, 2022, and even 2023, at least not yet. So that's a good sign. Plus, the consumer-driven U.S. economy has flashed signs of a comeback to start the fourth quarter, with some solid retail data out in October. And we should also note that there was some strong jobs figures for October that were released last week, and then upwardly revised figures for both August and September as well. With that said, we could see some more near-term selling pressure after that huge run we've already talked about, because we've seen some huge stocks and some major ETFs run back into some overbought technical levels after that big run. So we could see more of a pullback in the near term. That said, investors want to remain on the hunt for stocks, and timing the market is extremely difficult. So if you're a longer term investor, there's no need to be worried about if I'm getting in at exactly the right point, because the last couple months alone have showed how hard it is since people were calling for a big pullback. We got a little bit of a pullback and then soared right up to new highs with a 10% move for the S&P 500 in about a month. So with that in mind, we're going to take a look at these two big retail titans that are set to report next week. And the first one up is Walmart, which is set to report its Q3 fiscal 2022 results on Tuesday, November 16th, so next Tuesday. And for anyone who doesn't know, Walmart trades under the ticker WMT. The company posted a banner year last year in 2020, its fiscal 2021, and its year-long underperformance could set up an enticing entry point for the world's largest retailer. So last year, everyone knows the situation with COVID. Walmart's revenue climbed 7%, while its comparable sales climbed 9%. It expanded its delivery and various pickup options that helped drive 80% e-commerce growth last year. In an effort to directly challenge Amazon's popular Prime service, the company launched last fall its own subscription service, which it's dubbed Walmart Plus. So that service costs about $98 a year, or around $13 a month, and offers free deliveries, discounts on fuel, access to some in-store checkout offerings, and more. Reportedly, that service has already reached roughly 32 million U.S. households in about 1 year, and that's based on a recent Deutsche Bank report. So strong showing already for Walmart Plus as it tries to challenge Amazon Prime with those, as I said, those services, including free delivery. Walmart also is focused on landing partnerships with up-and-coming digital native retailers to help further compete with that big giant in Seattle. This includes teaming up with secondhand e-commerce clothing from ThredUp, partnering with Shopify to bring more small businesses to its own third-party marketplace, which is continuing to grow. So on top of that, Walmart is set to benefit from the booming digital advertising industry as more dollars are shifting away from legacy media. So obviously, the Googles and the Facebooks of the world still grab a lion's share of the broader digital ad market. But more online searches are beginning on e-commerce sites, and the money is following those people to where their searches are starting. So this has benefited Amazon and Walmart, and Amazon is set to continue to grow its high-margin ad business, which is on track to be a multi-billion-dollar-a-year segment in short order. On top of that, the company has spent and partnered with fintech firms to improve its own in-house financial services, and the company is also slowly building out a telehealth network around the country to complement some of its in-person Walmart health centers. So just continuing to expand its reach. So Walmart, obviously like Target and Costco and some other big box retailers, has posted a banner year last year. It was its strongest performance in forever in 2020. So despite these tough comparisons, Zacks estimates call for its revenue to climb another 1% this year and about 2.2% higher next year to reach $578 billion. Both of these obviously mark improvements on top of the year ago's impressive growth. And also earlier this year, our estimates were calling for a pullback slightly. So those top line estimates have improved since earlier this year. And then on the bottom line, we're calling for its adjusted earnings to climb 15% this year on top of last year, and then another 5.5% next year. Meanwhile, Walmart has topped our adjusted earnings estimates by 14% last quarter and 39% in Q1, and the company's overall earnings outlook has improved since its last report. That said, some recent downward revisions in terms of the last 7 days has temporarily hurt Walmart in terms of its Zacks rank, so it's seen some slight downward revisions for Q4 and its overall FY 2022 estimate down just about 1 cent for each of those. So that's had it slip to a Zacks rank number 4 sell at the moment, but obviously these are fluid rankings and they can change on a daily basis. So we could see that change by, say, tomorrow if anything changes on that end. So overall, Walmart lands an A grade for growth in our style score system alongside Bs for value and momentum. And it's also worth noting that its retail supermarket space is in the top 40% of over 250 Zacks industries. And as we talked about, there's broader positivity heading into the holiday shopping season, despite these rising prices and supply chain worries, with more people a little nervous when they enter some stores and see maybe more barren shelves than they're used to, certainly. That said, Wall Street remains really bullish on Walmart, with 12 of the 19 brokerage recommendations that Zacks has at strong buys. 3 more are at buys, and none are coming in below a hold. On top of that, its 1.5% dividend yield edges out the 10-year U.S. Treasury and the S&P 500's 1.2% average. So on top of that, we should look at some of the price performance recently. So the stock is up about 110% in the last 5 years. So this outpaces its broader industry by about 5% over this stretch. But if we look over the last year, the stock has performed not as well. So the stock is up around 3% in the last 12 months compared to the S&P 500's 34% climb. This downturn is part of a broader sector-wide pullback after that huge surge off the coronavirus lows. And within 2021 alone, Walmart's experienced some rather up and down movement. That said, it has climbed about 10% in the last month, along with the broader market. So Walmart had also reached significantly oversold levels in early October. It then recently jumped into overbought levels. It's pulled back a bit since then, and it's now sitting at 60 in terms of RSI, with 70 being that overbought threshold and 50 being neutral. So some positivity there in terms of some room to grow going forward. We should also note that the stock is trading well below its year-long highs in terms of forward 12-month earnings. So it's trading at about 22.7 times forward 12-month earnings, which is near its lows of about 21 times and well below its highs from last November, when it was sitting at about 27.2 times forward 12-month earnings, which puts it right almost at the S&P 500's average as well, and well below its broader retail space, which is trading at about 28.9 times forward 12-month earnings. So some value there for Walmart as well in terms of both its broader retail space and its own levels in the last year. And then at around $149 a share, it's trading a few bucks below its highs from last fall, which could certainly give it room to run. And the current Zacks consensus price target of $171.85 per share marks about 15% upside from its current levels. So therefore, investors with longer-term outlooks might want to consider scooping up this retail titan at what appears to be a solid entry point. And certainly, if you want Walmart to be in your part of a broader diversified portfolio, it seems like a solid bet within that retail space for not only the next several months, but the next several years and maybe several decades. So now we're going to move on to another giant that's set to report its quarterly results next Wednesday, the 17th. So Walmart's going on Tuesday, and Target is going to report on Wednesday. And that is Target, which trades in the ticker TGT. Like many of these huge big box retailers, much to the detriment of many smaller mom and pop shops, it's coming off a huge COVID boosted year and two strong quarters to start 2021. Actually, two really impressive quarters so far this year. So Target's e-commerce growth has helped its business boom during the heart of the pandemic, and its offerings will see it succeed in a retail age where consumers really want as many different options to shop as possible. So last year, its comparable digital sales were up 145%. Its same-day services were up 235%. And those offerings include in-store pickup, drive-up, and its Instacart-style shipped unit, which has people shop for you in the store and bring it to your house. Along with its new age shopping push, the Minneapolis-based retailer has focused on even more heavily on its own in-house brands. So this is everything from furniture and food to fashion and more. And its various store brands have succeeded because of its ability to adapt and stay on trend while remaining rather affordable as well. So Target's growing slate of in-house brands has helped it separate from rivals like Walmart and Costco within some key demographics. We should also note that after that big 2020 year, its second quarter results were really impressive as well. So it posted 9% comps growth in Q2, which came on top of 24% growth the year before. Its digital comps were up 10% on top of 195% growth in Q2 last year. So really just impressive growth across the board. And then we should note, which is something Wall Street is very excited about, is that 95% of Target's second quarter sales were fulfilled by its stores. So it's helping with margins that it's not having to fulfill orders from different places for its booming e-commerce business. Target has also successfully positioned itself as a one-stop shopping option as smaller retailers fade. So overall, if we look back, its 2020 sales were up 20%, adding about $15 billion to its top line in what was its greater than its total sales growth over the prior 11 years combined, which is really stunning that then it's able to grow on top of that in 2021. Meanwhile, its adjusted earnings jumped about 50% last year, and its margins continue to stand out from many of its big box peers, with its Q1 operating margin at a, quote, unprecedented 9.8%, up from a very healthy 6.4% before the pandemic. And then it just also posted another 9.8% operating income margin last quarter. And executives expect its full year operating margin rate to reach 8% or higher, to easily top last year's 7%. And we should note that its store brands represent a big portion of its sales mix and also is a big reason why its gross margin is strong. And then on top of that, looking ahead, Zacks estimates are calling for its Q3 revenue to jump another 8%, even though its adjusted earnings are projected to slip marginally. So looking ahead to the full year, its adjusted earnings are projected to climb another 37% higher, and its sales are projected to climb nearly 12% higher to see it pull in about $104.4 billion. The company has also topped our bottom line estimates by an average of about 37% in the trailing 4 quarters, though last quarter was less impressive with about a 5% beat. Investors should also be glad to hear that Target in early June raised its dividend by over 30% to 90 cents per share. And Target, just as a little side note, is on track for its 50th consecutive year in which Target has increased its annual dividend. So it's one of those dividend aristocrats. And its current yield of 1.4% tops the S&P 500 and roughly matches the 10-year U.S. Treasury. So unlike Walmart, who over the last year has roughly moved sideways, along with the broader retail wholesale market, Target is up 60% in the last year, which is part of a much longer and stronger run over the last several years. Despite that, it's still trading at a big discount to the industry, which it's trading at 19.9 times forward 12-month earnings, which is well below its highs, about 20% below its highs, and not too far off of its lows, which is a solid sign considering that the stock is up 60% this year and only sitting about 4% below its records in terms of actual price at around $254 a share. So Target lands a Zacks Ranked Over 3 hold at the moment, and A grades for growth and value in our style score system, and a B for momentum. And like Walmart, Wall Street is really high in the stock long term. So 16 of the 20 brokerage recommendations that Zacks has for Target are strong buys with nothing below a hold. So heading into both of these quarterly results next week, investors might want to consider either of these as a longer term investment. Obviously, Walmart's stock has lagged for the last year, where Target has still outperformed, so that could sway you in one way or another, but its past performance is no indicator of future performance in any way. So if you like either of these stocks better than the other, maybe don't add both to your portfolio, but either one looks to be a solid long-term play within a diversified portfolio, as these big, huge retailers that are set to continue to grow along with all of these massive retailers as smaller mom and pop shops, unfortunately or not, continue to lose market share. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.